What's up, everybody? I'm Logan Moody. This is the Contrarian channel where I talk about all things investing and market related and good opportunities out there in the market and perhaps different narratives in the market than what most people are talking about. Today I'll be talking about why the Fed is very likely very soon going to pivot from their hawkish stance on fighting inflation, why inflation might come down in the short term as well. So to get started, inflation has been very high. It's been very difficult for the Fed to get inflation where they would like it to be for the last year. First, the Fed was saying inflation was transitory. Then they were saying, it wasn't quite transitory. It would go away eventually. Then earlier in 2022, they began acknowledging that inflation was a lot more sticky of a situation than they were willing to acknowledge. They started raising rates on the short end of the yield curve, which is what they have control over. They started putting out very hawkish statements saying, we'll fight inflation as Paul Volcker did. We'll just raise interest rates until inflation comes down. But I'm going to point out some key things out there in the economy, in the yield curve especially, that is indicating that the bond market is already pricing in a recession. Investors are already bracing for a recession in the bond market. And this is going to effectively force the Fed's hand to pivot basically wherever inflation might be. Because in my mind, it's basically a 0% probability that the Fed continues to raise interest rates and just sends the economy and the stock market into a complete nosedive. That is not what they would do. In that kind of a situation, effectively the house of cards that they've built up for the past couple of decades would begin to fall apart in a way that they do not want to have happen. Effectively, what would happen in that kind of a scenario is the Fed continues to raise rates aggressively on the short end of the curve. The yield curve would then become even more inverted than it already is, and investors would effectively begin to lose confidence in the Fed as a whole. They would begin to lose confidence in the dollar as the world's reserve currency as a whole. The Fed does not want this to happen in any way, shape, or form. So in my mind, they will eventually have to pivot in the very near future, not very far off in my opinion, with how things are looking right now. So basically the yield curve has been inverted for the last couple of months, and it actually just became more inverted after the Fed's statement after the month of June, where they again doubled down on their hawkish statement saying that they would continue to raise interest rates. What an inverted yield curve effectively indicates is it has been a very effective predictor of past recessions. Basically every past recession in probably the last 20, 30 years has been effectively predicted by the bond market prior to the Fed actually cutting interest rates or anything like that, because the bond market is very attuned with the economy, with the different markets out there. Effectively, the bond market is the summation of all other investors out there who are buying bonds, whether it's different durations of bonds, whether it's treasuries, whether it's corporate bonds, etc. The bond market, to put it simply, is much more intelligent than the Fed itself. So what the inverted yield curve means is that investors are really desiring longer term bonds more than they are shorter term bonds. They see more risk in the future, so they want to put their assets into longer term bonds, whether it's treasuries, mainly looking at the treasury yield curve. Investors are definitely piling into longer term bonds right now. So that means that the 10-year, the 2-year is actually higher in return than the 10-year bond right now by a pretty significant amount. So this effectively means that investors are putting their money into longer term bonds, even though it is a lower rate of return than the shorter term. So this effectively is saying that we see a lot of risk in the short term. We'd rather stick with what we know is going to hedge our bets. In the longer term, we're going to put our money there. This effectively has been a very good indicator of past recessions, whether it was in 2008 prior to the financial crisis. The yield curve actually briefly inverted prior to the whole COVID fiasco that occurred, and now it's inverting again, although it has been inverted for the last 2 months now, and it actually inverted more just recently. So reason number one is the yield curve inverting effectively will be a major red flag for the Fed. Probably already is, but they just might not have realized the full implications of it yet. Number two is the economy is slowing very dramatically. So we've seen the bullwhip effect, as Michael Burry has talked about, play out in a big way in the last couple of months in terms of prices of goods, of services, of discretionary consumer spending. We've seen prices of these goods and services come down very dramatically in the last month or so. And this is due to the extremely high levels of inventory that were built up across the board in retailers, in car dealerships, etc. You know, and airlines. Effectively, they were pricing in, they'd been accumulating all this inventory, they'd been booking all of these flights, thinking that the economy would continue to be very strong, that demand would be very strong. However, they are now needing to get rid of all these inventories as it's very costly to continue to hold on to them. And in the case of something like an airline, they just need to get as many people to buy these tickets as possible. They will sell these tickets at whatever price they can. And so because of that, the price of these consumer goods have come down very dramatically. This will likely bring inflation down in the short term. This could give the Fed somewhat of a reason to pivot. You know, they could say, hey, we got inflation down to 4%, we got it down to maybe 5%, something around that. Now we're going to pivot because the economy is rapidly decelerating. Me personally, I would not be surprised. And in fact, I would bet that the market is going to come in negative GDP for the second quarter 2022 as well. It came in at negative 1.6% in the first quarter. If anything, I've seen more indication that it will be negative in the second quarter than I did in the first quarter. So if I were to guess that we are probably already in a recession at this point, when the data does come out in a couple of weeks, the Fed could also be effectively put on the spotlight then, as we would officially be in a what is defined as a recession of, you know, 2 consecutive quarters of contracting GDP. And so the Fed could then be put under the spotlight and effectively have to answer, you know, what are they going to do with regards to the US economy being in a recession. So that could be another reason why the Fed does pivot. But ultimately, it does come down to them needing to maintain the status quo for as long as they possibly can. They are not going to meaningfully fight inflation to actually get it under control if it continues to be an issue, simply because if that comes at the cost of them losing the whole system that they've built up in the past 2 to 3 decades of effectively backstopping every financial crisis that occurs, effectively bailing out every institution that needs it when it comes under scrutiny, economic hardship, the Fed is likely not going to let that happen. I say likely because there's a minuscule chance that, you know, suddenly they got very religious and are just going to let everything fall to pieces. I really doubt that's the case, though, because there would be very, very severe societal unrest in that kind of situation. All you have to do is look at a country like Sri Lanka right now, something like that, where there's just complete anarchy in the streets. So the Fed is not going to allow something like that to happen. They would rather just continue to kick the can down the road. So in my mind, a Fed pivot is coming much sooner than expected. And the last and final reason I'll point out is that the US bond market is actually already likely in the process of decreasing rates. It could actually already be easing. And so as the Fed did on the way up of chasing the bond curve in terms of tightening, as US Treasuries were effectively already raising rates long before the Fed was on the short end of the curve, now with rates potentially going down on the long end of the curve, the Fed could again have to play a catch-up race with them, or at least maybe just keep rates where they are instead of continuing to hike them. So all of these are just my thoughts in terms of why the Fed is likely very close to a pivot in terms of their stance on inflation, why inflation could come down in the short term a little bit, if not quite a bit, just due to the bullwhip effect and the inventory sell-off needing to occur. But all this being said, if you guys like this content, if you have any comments about this video, just leave them down below. If you liked the video, give it a thumbs up. If you didn't like it, give it a thumbs down. Let me know why down in the comments below, and I hope to see you all again at some point.